What if I told you McDonald's is making more money selling its brand than its own burgers? And this is stock number 4 in our 7-day series, showing you how to start investing in companies around you with StockOracle. So today's company is much more than just flipping burgers. So here's how StockOracle ranks the company on our 6 key metrics: predictability, profitability, growth, economic mode, financial strength, and valuation. We'll talk more about it later on. So most people think of McDonald's as an F&B giant. But if you look beneath the golden arches, if you get it, you'll find one of the world's most profitable real estate businesses hiding in plain sight. So McDonald's doesn't just operate restaurants. It owns or controls much of the land and buildings where those restaurants actually sit on, and then leases them to its franchisees. So this model turns McDonald's into a global landlord with a portfolio of prime locations. And the result, while burger sales keep the brand alive, rents and franchise royalties make up a bigger share compared to their own company-owned and operated restaurants. So let's look at how McDonald's actually stack up in StockOracle. Let's first key in McDonald's ticker symbol, MCD, and we are being greeted by this dashboard over here. And just by judging the Oracle IQ chart of McDonald's, we do see a little bit more so-called yellow or even orange flag here. I think as a very matured business, the growth is also pretty limiting considering their current footprint, and just trying to hike their prices due to inflation might also spell a little bit of trouble. That's why in terms of their expected growth today, both from an estimate growth for future or even looking at it from a historical lens, they actually rank pretty low. But I think the interesting thing about this case study over here is that McDonald's as a business, I think intuitively speaking, both as a consumer as an investor, you would think that they actually make most of their money by selling burgers. But their numbers actually speaks a different story. So just by looking at the historical operating revenue, breaking it down by business segments, you can see that they derive their revenue from 2 main sources. The one in dark blue is their franchised restaurants, while the one in the light blue is their company-owned and operated restaurants. And looking at their percentage breakdown, actually the franchise restaurants take up 60% of their contribution to their revenue. And similarly, when looking at the geographic breakdown, in terms of percentage, US is kind of like still the biggest exposure at 41%, while their international operating markets are roughly 49%. So in this specific case, especially I think for investors that didn't really dive into the numbers, McDonald's actually make more money trying to franchise the brand itself rather than selling burgers. And when trying to dig deeper into the numbers, specifically if you dive into their company matrix, you can see that they operate at a pretty high level of margin compared to other F&B related companies. You can see that the gross margins are easily 50-55%, operating margins over 45%, mostly because they're operating the franchises. So when looking at the overall business financials, just looking at top line revenue and bottom line growth, still respectable, but not very high growth as you have expected in a very maturing brand. And specifically, when trying to dive deeper into their business model, you can see that when compared to their debt and cash, they have roughly 1.8 billion in cash, but 55.8 billion in debt. Because you can kind of think of McDonald's as a pseudo real estate company where they own a lot of all these prime lands, where they actually lease them to their own franchisees. So which also kind of explains why the margins are so high, especially in this so-called F&B cutthroat era. To give you an example, let's compare it to another F&B company. Off the top of my head, I can probably think of like, let's say Starbucks for example. So when compared to Starbucks, I think when diving into their company matrix, you can see that gross margins, they're hardly even low 20% compared to McDonald's 50 over percent. And same thing for their operating margins, between 10 to 15%. Let's take another company for example, let's say Chipotle. So Chipotle is also in kind of like the fast food industry specifically. So diving into their company matrix, same thing. Gross margins 20 to 25%, operating margins being over 15% is already pretty respectable. And compared to McDonald's, I think they have a much more unique business strategy and business model right here. And to dive deeper into McDonald's as a company or a potential investment idea, diving into their AI mode analysis, they clearly score a very wide mode, mostly due to their brand loyalty and pricing power and the high barriers to entry due to their entire portfolio of real estate. And of course, the economies of scale and the protocol and systems that they've already created that allows them to easily franchise themselves out here. Now, I think one other feature that on StockOracle you can really exploit is this compare feature or compare function. And when we look at some of these other names that we compared towards, in this specific compare function, they will automatically populate some of the potential competitors that you can look at in this whole F&B space, and to do a little bit more, I guess, competitor research and to see how McDonald's actually stack up to them. And we have already done some of these comparisons like to Starbucks and Chipotle, but you can also look at other names like Yum Brands, Yum China, Domino's Pizza. And through some of these ideas, you can also shortlist your own watch list to do that comparison and to track them accordingly. So after having populated this list, you can actually scroll down to see the Oracle IQ at one glance across different brand names. And you do generally realize that a lot of all these fast food chains or restaurant names, they all rank very high on predictability, but not so much in terms of profitability and maybe even expected growth rates. I'm just looking across these 6 names, they all kind of look pretty similar. So that's why I think for different companies, they all have different roles to play in your portfolio. And I think McDonald's as a company, it's a very strong brand. They have very wide moat. I don't expect them to be easily disrupted by other names to come in the F&B space in the upcoming 5 to 10 years. But that's it. I think in terms of valuations today, will probably be top of mind concern. So that's basically how I look at McDonald's and StockOracle today. So what's the takeaway here? Even within the same industry, business models can be completely different, and those differences matter a lot for investors. On the surface, McDonald's and its fast food peers might look similar. They all sell quick, affordable meals. But once you dig into their numbers, you see McDonald's isn't just in the burger business. It's in the real estate and royalty business instead. That's why their margins, cash flow stability, and resilience look so much different from a company that relies purely on their food sales. So for new investors, the tip is simple. Don't just look at what a company sells. Study how it makes its money. So read the segment breakdowns in their annual report, compare margins and revenue sources with competitors, and ask yourself which model is more durable over the long run. Sometimes the real edge isn't in the product itself, it's in the business model that runs quietly in the background. So with StockOracle, it's versatile and doesn't just give you numbers, but lets you test it yourself. And if you want to get access to this investing tool, you can head down to the link below to check out our latest offer. And this is CK from Piranha Profit signing off. Till next time, keep winning.